Good evening, everyone, and welcome back to the Pro Investor Business Plan Live series, part 6. So it's already been 6 Sundays, 6 weeks, and we've done quite a lot of progress already. My plans for today is to finish my trading rules. So we're going to speak about valuation, the best fundamental setups, putting all the puzzle pieces together, and then we're going to potentially cover step 4 as well as step 5, which then goes into market timing and trade management. So that next time we can then start to go into my investing rules and also trading log, right? So we're just going to take a couple more Sundays, I guess, including today. Let's see how long we take for my investing rules, but for the trading log, we're potentially going to take one session, but a longer one for that. That's the plan for today and for the coming weeks as well, just so you guys know the big picture. So without much further ado, let's just get straight to Campus Valuation and our valuation index or valuation tool that we have created. Campus Valuation is a great tool. It's a very diverse tool because it allows us to get a sense of value, not just for stocks and equity indices, so our infinite markets, but it also allows us to get a general sense of value for all other markets as well. Whether we trade finite markets, whether we look at commodities, whether we look at our Forex markets, we can value those kinds of markets that we look at against interest rates, against gold, against the US dollar, depending on what we do. And the most powerful way on how we can use Campus Valuation is it is a tool to be used for our infinite markets, so for our stocks and equity indices. And that is because I believe that there is a relationship between stocks and interest rates. And what usually happens is that there is a specific spread in terms of how close together or how far apart these are. And so, of course, we know that nowadays interest rates have an extreme influence on the prices of stocks. So whenever there's a Fed interest rate decision on the horizon, we can see that stocks really go crazy. And that is just because interest rates, more than anything else, moves our infinite markets. So what we want to do is we want to compare the price of any stock, and that could be an equity index as well, on a ratio to interest rates. So this would then give us an indication of whether a stock is priced relatively low compared to interest rates, which then would be undervalued, or if a stock is priced relatively high compared to interest rates, which then would be overvalued. So when we speak about valuation, we just talked about this. Stocks and equity indices, we're going to value against interest rates. And for this, we're going to look at the bond market. The future symbol for that is at US. As I also mentioned, we can also value commodities and the US dollar. We would value that against gold at GC. And that is just because we believe that gold is the ultimate storehouse of value. So with that, we can value commodities. And majors we could value against the US dollar. And so in fact, there's probably much more we could look at. Some of you guys, like Sival, for example, once mentioned, hey, couldn't we look at crude oil, for example, as well, if we know that there's a relationship between, for example, the Canadian dollar and crude oil, then maybe I can value the Canadian dollar against crude oil, or maybe I can value stocks against crude oil. All of these thoughts are very valid, and they may be, and this idea that you're having may be true. So what you can always do is, of course, you can backtest your valuation idea, and that's at the end of the day all you have to do. And if you see that most of the time your idea, as you backtest it, holds to be true, then you can use that as well. And in fact, for equity indices, when we look at interest rates, that is the easiest one to explain, right? Interest rates move stocks and equity indices. So yes, of course, and that is also why valuation works the best for that, for our infinite markets. For commodities in our finite markets, we know that we would anyways prioritize our COT data. And for Forex, it's a bit tricky, because actually Forex, we could value against anything. We could value against the dollar, against gold, and against interest rates as well. So for Forex, I use a specific rule. When I do Forex, I look at all three of them, at US, at GC, and the dollar. And I use a 2 out of 3 rule here, right? Now, what about the cycles here? When it comes to under and overvalued, there's no magic number to the cycle periods that works best on each market. For some market, it seems like a 10-day works better than 30-day, and for others, it is the opposite. For most stocks, we use a 13-week cycle period. That's to do with the earning seasons, the quarters, right? They represent quarters and earning seasons. We know those are important cycle periods for stocks. And as we use daily cycles for trend trades, we would use weekly cycles to argue a potential trend change. So how are you going to combine now all of this, right? So we have the Campos COT index, Campos true seasonality, and the Campos valuation. How are we going to combine all of these tools to get the best bang for our bucks, right? The best fundamental setups. I believe those fundamental setups change depending on what markets you look at. So I basically divided all of our markets that we trade into finite markets, commodities, into infinite markets, equity indices and stocks, and into man-made commodities, Forex and treasuries. For our finite markets, for our commodities, we can either forecast a major rally fundamentally, or we want to forecast we can forecast a major decline fundamentally. And that we do just by looking at the COT and the seasonal data. And if we have a bullish COT plus a seasonal low, then we can forecast a major rally. If we have a bearish COT plus a seasonal high, then we can forecast a major decline. Some examples here where this took place, for example, precious metals. We had bullish COT data, we had a seasonal low, and we got a major rally. Forecasting a major decline, some examples, for example, at the moment are coffee. We had bearish COT data and a seasonal high. So we also got a little bit of a drop already, and the potential for a major decline also in the markets. That is finite markets. What about infinite markets? Well, here I'm going to look at undervalued plus seasonal low to forecast a major rally. And to forecast a major decline, I'm going to look at overvalued plus a seasonal high, right? And so you can also see that's also the priority on how I would look at things. Now, if I, for example, for equity indices, right, Nasdaq was heavily undervalued and we had a seasonal low, then of course that's a good buy point. And so we got a major rally and put the potential for a much bigger rally to still come, right? And so the priority that we have is that for equity indices and stocks, I'm going to look at undervalued as a higher priority than the COT data, though I look at still the COT data. What is going to overrule if I have mixed messages though, is going to be exactly the valuation, right? Because I know that interest rates is the thing that moves markets most for those. When it comes to commodities, I'm going to look at the COT data as a priority. Still, I can look at valuation, but valuation is not going to be a deal breaker. Neither is it something that is potentially going to make me go into a trade if I don't have the right COT data. So the priority is very clear here. It's COT, then seasonality. And for infinite markets, it's valuation, then seasonality. And for our man-made commodities, Forex and treasuries, we're going to look at everything, right? We're going to look at valuation, COT, and seasonality. We just have to do it because the man-made commodities, right, they're a little bit of both. They are finite and infinite markets. And so that's why they're man-made, right? They're artificial, basically. So we should be looking at all of those. Now, you could be saying on our finite markets, you could be saying now, what if I have a seasonal low and I don't have the right bullish COT data to back up that seasonal low? Then it depends on what you have written down in your trade plan on what you're going to do, right? I'm going to act on those setups right here, where the seasonality on all aspects is not a must, but could be at times a deal breaker, right? It could be at times a deal breaker, but it is not a must. While the valuation as well as the COT data is a must, right? Because that is what at the end of the day moves markets. Firas, you're saying COT works for Forex in TradeStation setup. COT would work on TradeStation. COT would work for your majors as you look at them with the future symbol. So with that, with at EC, at JY, at SF, here the COT data would work. But if you were to look at the Forex pairs, then this would not work because it's futures only data. Does that make sense for us? Cool. Whenever we have these best fundamental setups, whenever we have the green lights on our fundamentals and we align that at the end of the day with our technicals, then again, what we're allowed to do is we can go ahead and over leverage on a trade, right? So that is exactly the things, right? When you have this alignment and also with the technicals, then you can go ahead and over leverage on a trade. But generally, most of my trades will look similar to this, and they will at least have the fundamental drivers. And if they also have the seasonality on top, then we basically have an all stars aligned scenario. You just have to look back on the few trades that we had, the trades that that seemed to get the biggest moves were the ones where we had all the things aligned, right? So this is what we should look at as well. So when all the things are aligned, what are we going to do next? Because so far we've just had a technical setup and we've had a fundamental setup, and now they may be aligned. But how are we going to time the markets now? Well, we were going to time the markets based on our lower timeframes. We use the lower timeframes to maximize our profitability in the market. So what we do here is, again, we're going to identify supply and demand zones. And that is now very important, that are located within the right fundamental context and technical context of the entire analysis that we've just done, right? So they need to be located within the right fundamental context or fundamental indicators, and the right technical context, our higher time frame direction and higher time frame location. And then once we find these supply and demand zones, whatever we're looking at, we then go ahead and validate those zones based on our zone qualifiers. Now, in the beginning, you need to be extremely stringent on the way how you look at your lower time frame levels. In general, the lower you go in terms of time frame, the more accurate you want to become, the more scientific you want to become, because the lower we go, the more difficult it is going to be to really pinpoint that imbalance, the less margin of error we basically have. And so as you were a beginner, you really want to look at all of these rules that I have mentioned here. Once you become more advanced, you're going to start to look at the things in a little more gray fashion, right? Where experience meets the rules. In the beginning, I want you to do this black and white, black or white. Later on, it's going to be more gray. And what these rules are meant to do, they're meant to train your eyes to look at specific things, right? You need to train your eyes. The only way how you can train your eyes is if you have a clear set of rules. Otherwise, you cannot train your eyes to look at something specifically. Over time, you will get less stringent and more gray when it comes to all of these rules. So rule number one, leg out explosive candles, of course, or abnormally bigger decisive, followed by at least one more decisive or explosive candle. And the rule that I think is more important to look at is really to have an eye on the size of the candles, whether they're at the end of the day, whether the candle to wick ratio is explosive. That doesn't really matter that much to me. Ideally, of course, they are, but if they're already abnormally bigger candles, followed by a large move, followed by more decisive candles, then that is good enough. That is good. That would be good enough for me. Profit margin, price must have traveled at least a minimum of 1 to 3 away from the zone. That goes in line with kind of the leg out analysis. What you want to make sure here is that you're really following the abnormally bigger rule, and that you really have follow through as well as price is moving out of your zone. Freshness, of course, it must be fresh based on the wider version. Again, as I said in the beginning, this is what you're going to have to follow. Later on, you may be saying it doesn't have to be fresh on the wider, it can be fresh on the, it only has to be fresh on the preferred, and so on and so forth. Kind of depends on the time frame that you're operating as well. Of course, if you would be doing a 240-minute time frame, then it would have to be fresh. The higher you go in terms of daily and weekly, if you use that as a lower time frame, freshness again is not really as important as if you would compare that to a 60-minute candle. So it always also depends on the income goal here when it comes to freshness. But in the beginning, it must be fresh on the wider version. Later on, you can change that depending to your needs. Base duration, approximately 1 to 6. Ideally indecisive candles, pin bars within the base. Again, that is something that I want you to have an eye on in the beginning, but later on, you're probably going to choose to you're going to choose to not have a very high preference or a very high priority on this specific rule. Arrival, which is a rule only for counter trend trades. And what we basically look at here, we want to make sure that as price arrives into our zone, there's no opposing zones that had been created that would eat into our profit margin. And so the advanced rule on all of these is that with growing experience, you're allowed to create your own alternative zone qualifier set of rules where not all the rules need to be in place. What's very important when we go to the lower time frame is that we could be the best lower time frame charters there are, right? If we don't trade them within the right context of fundamentals and technicals higher time frame, then all of this is for nothing, right? If we trade within the right context of all of that, then we find sometimes most of the time that very sloppy areas, very cheeky areas work beautifully, right? And that makes sense because we are picking the right, we are directionally picking the right trade, right? And that's what I also said towards the end of last week's session. I said we need to be assessing our trades based on the context, whether the context was right when we analyzed it or whether it wasn't right. And if it was right and we missed a trade or we got stopped out, then it may have just been a market timing issue. We may have just, we may have just been unlucky with the way how we tried to get in to this market. If most of your losers come from fundamental, come from the context itself, that you were trading against the right kind of context, then you need to work on your step 1, step 2, step 3 skills. And this is what you should be prioritizing as well. Especially in the beginning, try to prioritize, try to predict large rallies and large declines, try to be directionally right most of the time, right? Have the right idea of where the market is going to go and when that is going to take place. The market timing, trying to get a handle on those trades, that is in theory the easier part. But of course, it's the more emotionally stressing part, because at those times when we want to get into the market, we may be extremely fearful. There may be a lot of bad news. Markets may have dropped big time, like it was now the case with equity indices, right? I had so many conversations with so many people that were incredibly bearish overall. Right. And that is just because our minds are kind of news driven. That's how we are wired. And it's extremely difficult to then actually be bullish when we have to be bullish. That's why we have all of our rules in place, so we can actually be bullish when everyone else around us is bearish. And we can be bearish when everyone else around us is bullish. So that is kind of the easier part technically, because we know what direction we want to take, but it can be emotionally very difficult because we need to be buying when everyone is selling, and we need to be selling when everyone is buying, which of course is a very difficult thing to do by nature, also for us and also for an experienced trader and also for me, right? Oftentimes I have to fight with that, with that as well. So and then after all of that, Of course, we're going to check for our advanced zone qualifiers. So these are just the basics, right? And then we're going to go a step further and we're going to say, let's check level on top of level. And let's also have an eye on flip zone and potentially originality. On a level on top of level, we're always going to set the lower level based on the wider version for demand and set the higher level based on the wider version of supply. When I say always here, right? When I say always, of course, this needs to be your rule for the beginning. Later on, you can also use the alternative step 3, price action, to time those kinds of levels on levels, or even where you have multiple levels, more than just 2, right? Then we need to really look at alternative steps. Flip zones, of course, not having a flip zone or the zone not being original does not invalidate the zone, but of course it would make it a little stronger, or we could filter on, if we have multiple zones, we could filter on what may be the better zone based on flip and originality. But not having that is also not going to render a zone as a negative, as a bad zone. Alternative steps here is that we can use our price action and signature set of rules and wait for confirmation, right? We could wait for confirmation. What does that mean? Price action and signature, hammer candles, shooting star candles, hanging man, bearish engulfing, bullish engulfing, trend line breaks, head and shoulders, and the list goes on and on and on. And so how are we going to enter? Enter above prior day's high. Prior day's highs or prior day's lows. That is how we're going to enter. But of course, here you could also put down more entry rules, right? You could put down more entry rules. For example, that is just usually my set of rule that I have. I'm just going to enter above the prior day's high or low when we get an an engulfing candle or a shooting star or whatever it may be. But we could also wait for lower time frame pullbacks at this point, and so on and so forth. When do I use confirmation? Multiple or large levels, which makes a set difficult. And so that is something that oftentimes happens, that we just have so many levels. We can't really decide. We can't put our finger on a single level and say, this is the best. So we kind of have to wait for the markets to show us that they want to reverse with those kinds of formations or candles. And then we could react to those market reversals. If the reversals per se, that's how I use it personally, right? And I always use this set of rule. If I see enough profit margin. If I don't see enough profit margin on a reversal, sometimes you get large reversal candles, very, very large reversal candles. If I don't anyways get enough profit on a reversal candle, then I will wait for the market to go into reversal and trade the first newly formed lower time frame zone with that as we go into reversal. So that's how I deal with it, right? I just try to enter if I see enough profit margin. If those reversal candles or areas become extremely large, then I'll wait for a pullback. I'll wait for all of this to play out and then give me a pullback. Why I do that? Basically because, well, I could be just doing a reversal still and entering the next day, and this may work out, and I may make a 1-to-1 or a 1-to-2. So that would be great, right? But the thing is, if I don't do that, I may miss out on that. Well, if I miss out on a 1-to-1 or a 1-to-2, even though I was directionally right, I can miss with that. I can live with that. And so if I can achieve the 1 to 4 or 1 to 5 with my setup, then that's a lot better, right? Over time. And so I try to do that consistently. Now, once we are in the trade, right, market timing, once we've timed the market, then of course we also need to manage that trade. And so key points on trade management, before we go even into trade management, is we need to know when to hold them, and we need to know when to fold them, right? Very important. How do we do that? Basically, in the beginning, I want you to have again a black and white rule based on risk to rewards and ratios, just pure mathematics, pure statistics. Later on, though, I want you to have a little bit more of an advanced trade management set of rules, where we're going to talk about technical and fundamental risk, and we're going to trail with that. In the beginning, it's going to be tough for you to identify that. So therefore, you're going to be black and white with the way how you do it. Later on, we really have to know when to hold them and when to fold them, right? Learning how to hold on to winning trades, I think, goes in line with 1. Our natural tendency is to take small profits to pay off recent losses. That is something that I see over and over and over again, and something that we need to overcome as well in the long run, is when we get a good trade on our hands, one that we potentially want to hold on to. If we had incurred recent losses, we may take small profits on a trade where we should taking large profits. So the only way to make up for losses is to make large profits, right? And so we need to get away from that natural tendency to take small profits. Our fear of losing profits exceeds our hope of holding on. That's oftentimes the case. I will, at the end of the day, if I have locked in a certain amount of hours on one trade, I will also lock hours in terms of stop loss management, right? There's going to be a fine line where we're not going to be pigs about that, right? Bulls and bears get fat, but pigs get slaughtered, like the old Wall Street saying goes. So there's going to be a fine line with all of that. But as you can see, we can't be too greedy, we can't be too fearful, and all of our decisions should be logical decisions, and not emotional decisions. And so all of these, they would be emotional decisions. Sometimes it's okay to take an emotional decision to lock in some hours depending on the situation that we're in, but most of the time they have to be, logic has to overrule our emotions. And so let's start with our basic trade management rules, the things that I want you to follow in the beginning. It's very simple. We're going to determine whether we're in a trend, in a counter trend, or whether we are doing an anticipatory trend trade. And we can move our stop loss to break even at a point of either a 1 to 2 or a 1 to 1 risk to reward. When we trade with the trend, that's the more conservative kind of trade. We want to give price more wiggle room. We want to give it more breathing space. So we generally wait for 1 to 2 here until we move our stops to break even. For counter trend and anticipatory trend trades, as we were more aggressive with the way how we're trying to time the markets and what we're trying to predict, right? It's a lot more difficult to do than to trade with the trend. And so therefore we also need to be a little faster as it comes to the trade management and moving our stop loss to break even, which we then basically do at a 1 to 1 for each of those trades. You should have set targets in the beginning when you collect hours. You should have targets set at a 1 to 4 when you trade, I don't know why this is mixed around, 1 to 4 when you trade with the trend, 1 to 2 when you trade against the trend, and 1 to 4 as well when you trade anticipatory, because in anticipatory you basically say there's a large new trend forming. There's an option to have two two targets, but I understand that most people naturally only trade with one target. And that's fine. If you have two targets, that's also fine. You will just add your target settings for that as well. What about so that's pretty straightforward, right? Very, very straightforward. What about our trend? What about advanced trade management set of rules? Well, for advanced trade management set of rules, it's very tricky to put this into writing because it's very situational, but we can put some things down. What we always have to do is we have to identify technical risk and fundamental risk. So technical risk would be, is price approaching opposing supply or demand zones where price could react from, and therefore if it's going to go against us, it's going to go against us from these areas. And then has price left large gaps on the way up or down is also a way of identifying technical risk, because if there's large gaps that are potentially or likely to be filled, then we also may want to, move our stop loss to break even. And then fundamental risk is asking ourselves, has the underlying fundamental conditions changed? In other words, what's the COT data saying? What is seasonality saying? What about valuation, right? And so have the fundamental conditions changed, or are they worsening? If they are, then we may also want to protect ourselves in the process. Step 3, identify targets that should be reached based on my analysis, right? So a lot of times you see that the targets that I had mentioned in terms of the technical picture, supply and demand, monthly charts, weekly charts, trend, condition, most of the time those targets are also hit at the end of the day. During that time though, we may take, price may do large swings in the process. And so we have to work with like larger corrections when we're in a trade, where there may be periods where price goes against us for a little while before it then moves into the final targets. And so most of the time you can see that those technical targets are pretty dang accurate, right? And so that is just my eyes, and that's basically a rule that I cannot put this in writing, because this is combining everything in terms of the technical setup 1 and 2, and also potential lower time frame opposing zones that are within the higher time frame supply and or demand setups here. And so it's very difficult to be at a stage where you're going to say most of the time price does reach that. Even, that being said, most of the time when I identify a longer term target, a larger target, I probably will not manage to hold on to that trade until that stage, right? And that is because I will start trading aggressively and I want to start locking in R's as we have a lot of R's on the table. So that is where step 4 comes into play. Until target is met, we'll trail using the following rules. So If we get a technical risk, and the running risk to reward is bigger than 1-to-1, I will put my stop loss to break even, right? And so you saw that on our equity index long idea, where I went long, then price went into opposing supply. I didn't, we had more than a 1-to-1 at that stage, but that 1-to-1 was almost meaningless. I knew we were in supply, and that if price turns, we're going to turn from there. So therefore we put our stop loss to break even. And so that is the rule on when to put your stop loss to break even. When is price at the opposing area, where, of course, if you get a bounce, we get a bounce out of our levels, price has to go somewhere until it turns. And so if it doesn't break our level right away, right? And so price has to go somewhere until it then turns, and usually that's opposing supply on demand levels. So that's the technical risk. And then sometimes that stop loss to break even is good, sometimes that's bad, right? And so it depends on what is it going to be on average. If most of the time you're moving your stop loss to break even is bad because you get stopped out on break even a lot, and then you see price moving without you, then of course you have to change your set of rules. But if on average it's a good decision over a bigger sample size of trades, that usually when you move your stop loss to break even, you have enough wiggle room. You know that if price turns now, it's pretty bad, or it could be pretty bad, and then on average it's good. You're very good at putting your stop loss to break even on average, then of course you can leave it at that rule. For me, that's just the case, right? I still like to put most of the times my stop loss to break even. I will have some trades where I will not put my stop loss to break even at all, right? And so when I'm in the trade, basically and that is when I don't see technical risk opposing. Then there may be a case of technical risk and running risk reward bigger than 1-to-3. We're going to do an aggressive technical trailing, tight stop loss below 1, 2, or 3 days lows with potential lower time frame level coverage. That is something that I will usually do as I'm collecting R's. If I'm in the process of collecting R's and I'm bigger than 1-to-3, and I see that, oh, technical risk on our running trades, we're at or close to opposing levels and zones, then I'm going to go ahead and trail aggressively, basically lock in some R's as I'm in the phase of collecting R's. There could be an exemption to that, where you're going to say, I have already collected a lot of R's. I see a lot of potential in this trade. And so therefore I'm going to try and let that trade, I'm going to try to let that trade run until it goes to my final targets, which there is always an argument for as well, but only if we have a buffer. If we don't have a buffer, if we don't have a buffer, there's no point to hold on to a lot of our trades beyond 1-to-4s, because a 1-to-4 is just so big in terms of collecting R's. There's not much more we need. Sometimes we manage to do more than 4s, which are then also great trade. It's great addition to additional R's, but it's not really a make up. It's not really a make for us, right? We don't need the 1-to-10s. We just need to have a 1-to-2 actually on average. So there's a scenario of technical risk and fundamental risk, regardless of risk to reward. And so there's going to be an aggressive trailing approach with the same 1, 2, or 3 day low stop loss, and with potential lower time frame coverage as well. And you can see when there's technical and fundamental risk on the table, we usually do want to get out of those trades, because then we also would believe that the trade, that price would turn eventually. So we would be aggressively trailing with that. There's an exemption to the rule on certain trades that meet the best fundamental setup rules, analyzed on trade by trade basis. I'm allowed and can decide to not trail unless I see the fundamental condition to change. Right? If you're holding on to a big trade that you believe is a big trade for some of the fundamental reasons and or technical reasons, like for example, if I was holding on to the equity, if I was still holding on to the equity indices from the lows, then I would be holding that trade not for a 1 to 4. I would try to hold on to that trade without trailing a lot, without trailing much, basically. And so that always can be argued. And if over leveraged, then usually I would also argue to have a monetary target of X dollars in mind. So if price hits my target amount, I will exit the trade. So a well-executed over-leveraged trade gives me double the R's or sometimes even triple the R's and can make a big difference in my trading log. Not just in the trading log, but in the trading within the trading statements and accounts as well. So at this later on, right? Later on, it'll be as you're risking a higher amount and you're over leveraging, you're going to have to be monetary driven as well, not so KPI driven as were in the beginning, because KPIs are great to measure our performance at some point. As you know over time that you are a good trader, you don't need to measure your performance objectively. You want to work a little more on monetary targets. So this is a great way of leaning into this idea of, hey, let's have monetary targets of X dollars. You'll know pretty quickly what it means to how important it is to have monetary targets, because our brains are wired to eventually not function properly anymore as we see certain numbers on the screen. Those numbers are different to all of us. They're subjective. And so eventually when you see a number on your screen and you find yourself taking wrong decisions at that stage, at that time, over and over again, then you may have a monetary barrier at the moment, an emotional barrier in terms of the amount that you see is just too big at the moment for you emotionally, so mentally. And if that results with you taking wrong decisions and anyways walking out with less than you could have made, then you need to start putting in place a monetary target of X dollars, right? That could be anything. That could be $1,000, that could be $10,000, could be $50,000. Whatever you see on the screen, and you find yourself, oftentimes you can get much higher above that anyways, because then it goes higher and then you're like, oh no, I want to anyways lock that. Then you lock that, or you find like new levels that have been formed, protect yourself, and then, or you protect yourself very aggressively. At the end, you walk out with less anyways as you start doing that. So might as well just take the profit. But what your monetary barrier is in terms of targets and dollar amount, obviously there's also something that you probably won't have from the beginning, from your beginning milestones, but it is something that you're going to run into. Once you run into that, you need to have a monetary target of X dollars written down here. But that is also rather advanced in the beginning. Of course, mostly I want you to work with your KPIs mainly, and not with monetary targets. So that's all in terms of my trading rules. Are there any questions that you guys have when it comes to my trading rules on anything of the my trading rules topics? What makes markets move, location, direction? indicators, COT, true seasonality, valuation, combining them all, the market timing on a lower time frame, and the trade management aspect of it as well. So you can see trading rules are quite comprehensive. So if you have questions, now would be a good time. We have like 10 minutes left, so we can also quickly start. We can also start already the My Investing rules. All clear? Great. All clear. Perfect. So let's jump into My Investing rules. Of course, we're going to have a different set of rules when it comes to investing as opposed to trading, right? Very two different strategies that deserve their own unique set of rules, because also the way how we tackle those markets are very different, right? So I want to start off My Investing rules actually with a topic that doesn't just relate to investing itself, but also to the skill of trading and acquiring the skill of trading. And it's basically, it takes time, right? It takes time for your trading career and your money to grow. A small investment can become a big investment, but only with time and time alone. Time creates growth. Huge profits do not come from overnight. And so guess what else takes time? Growing a business, climbing up the corporate ladder, a degree, even growing crop or plants will take a long time. So when it comes to investing, we always need to think of what we can achieve in 5 to 10 years, rather than what can we achieve next month, right? What kind of milestones in trading can I achieve next month? Am I achieving my KPIs? In investing, it's a very different mindset that we have to have, and which is, I know, mentally also a lot more difficult to have a clear focus when it comes to longer term wealth and retirement goals. It's a lot more difficult for us to do. What are the kind of fundamentals that we follow? And why do we follow fundamentals at all? Well, fundamental indicators help us determine and time market bottoms and tops. So we have an idea of when to get in and out of the markets. When we deploy a lot of capital, we need to have a lot of confidence. And therefore, we need to have certain tools that will help us in identifying recessions, so we can potentially sidestep them. But we also need tools to help us identify bull runs, bull markets, so we can timely redeploy and get back on the bull train. Or if we have never deployed large sums yet, also identify the risks of a recession and whether a bull run that exists in existence already is going to be continued or not. And so for this, we use a variety of tools that cover most aspects of the economy, ranging from future GDP projections, employment trends, interest rates, and PE valuations. So we use a combination of those. And as you can see, those are fundamental setup tools because they look at the economy. And so as we, for example, say now, for example, on our equity indices, the equity indices are not in a bear market. That's just a correction, right? It's just a correction because we had all of our tools looking at the economy and none of those would give us a warning signal. We do that once a year, by the way. We did it this year as part of a separate recording that you guys can find within the stocks recording section. And it's basically called the 2022 roadmap. where we did predict early year weakness and a low in and around February, which now came a little later than expected. But at the end of the day, it was still a good time to buy. It is still a good time to buy. We are not predicting a crash, and so we can never predict. Anyways, we can never predict a crash. The understanding of a market crash and a correction and or slash bear market, these words are so widely misused. It's terrible in my, sometimes in my books, how wildly they're used and how everyone kind of misuses them, and they just use them as interchangeable words. For me, they're very different. A bear market is not a market crash, and a market crash is not a correction. A correction is not a bear market, right? And so my definition of what these three mean is very different, maybe very different to other people, but basically we can say that a market will only go into a correction, which is the first phase of a bear market. A correction will only lead into a bigger correction, a bear market, if we see the fundamental conditions worsening, if we can predict a recession. Because the only way a correction goes into a bear market, rolls over into a bear market, is if there's a recession around the corner. Otherwise, every time in history, a correction has just been a correction, not a bear market. A correction has gone into a bear market when there was a recession on the horizon. There's no recession on the horizon at the moment, right? And so, and then a crash only comes with the markets having moved into a bear market and eventually just taken everything out very quickly as fear overwhelms most investors. And so first it's a correction, then it goes into a bear market, and then there's usually a crash. That's how it goes. And a correction will only turn into a bear market if we can see a recession. How can we see if there's a recession? Well, we look at, and by the way, we don't look at the kind of the investing data here, right, on investing.com, because all of this data that we would see there is lagging data. We're using our own sets of data, which most of them are future projections. So again, we try to look through the front shield, not through the rear view mirror, because if I look at GDP data, for example, and I look at the ones that get released for free, well, the future GDP projections that we look at is also free, but that get released based on historical data that cover like the last quarter or the last month or the last year, this is past data, right? This is lagging data. It's not gonna, knowing what last quarter was as I'm investing today for the future is not gonna give me any input on what I want to do. I need to look through the front windshield, not through the rear view mirror. And so we can only do that as we look at future GDP projections. And there's one group of people that have an extremely good track record of projecting a potential decline in GDP, a future potential decline in GDP. And so here we would look at the anxious index, and then we look at employment trends, which then is the Conference Board employment trends data. We can create an index out of that. We look at interest rates, which then is the dynamic yield curve, and we look at PE valuations, and those can be found as well online too. We don't have to even do our own calculation on that. And so if we look at those fundamentals and all of these fundamentals show a green check mark and we get a correction, then let's use that correction to buy, and let's not see that correction as increased risk in the market, right? Most people will just argue that as price declines, there's a higher risk in the market. I would actually argue the other way around. As price corrects, there's less risk in the market because naturally we can buy at lower prices. And so that thought is very interesting. And so we need to treat, and that's why we have those fundamental tools, so we can understand, hey, if we get a larger decline, is it a correction? Are we going to buy into that correction, or are we not? And so of course we are, because all of these, apart from the PE valuations, which are a little worrying, yield curve was starting to get a little worrying as well. But overall, all of these three are still very much green, giving us a green light. On top of understanding the market cycles as well, in terms of the decennial year, right, that Edgar Lawrence Smith started his work on, decades ago. And then Yale Hirsch kind of followed up on that belief and came up with the phenomenal 5, and then we just have to continue to kind of track and log that data and see if this continued to hold on, and so far it is. And their belief is that every year price moves within the same pattern, and that every year within a decade also price moves within the same pattern. So usually that 2 and 3 years ending with 2 and 3 are usually the beginning of bull markets. Guess what? We're in 2022, 2023. Phenomenal 5. Those are the years we have to be invested in. If you see those make the craziest gains, if you see someone calling a crash within the 2025, then you just know they have never even heard anything about stock market cycles. Even now, I would argue people that call on a big bear market, understanding that we're in decennial 2 and 3, usually also those people don't know a lot about fundamentals and cycles, market cycles. They've never even heard of that. And so as we overlay that, of course, with our fundamental tools, the cycles overlaying on our fundamental tools, we can argue, hey, it's the beginning of the bull market. We have green lights and so forth. We get a correction, that's fine. We use the correction to buy into lower prices. Also a question in terms of cycles, what is the election year and the decennial cycle in terms of best buy points? All of that we do, right? We provide you guys anyways within the yearly roadmap. So I do this for you. We do this for you anyways. You just have to watch it. However, you want to start doing that yourself as well and really get a good understanding and back testing all of these tools yourself eventually. And so number 3, and I'm going to end with that, is choosing the strategy that fits your capital and performance requirements. And then we'll start buying, we'll start deploying with the cycle lows and higher time frame demand. That's what we do, right? And that's all we're going to do. And that's our job done. And then in the next few sessions, we're then going to talk about what are our strategies, Campus Equity Index, Campus Comparative Strength, other stocks, and our crypto portfolio. We're going to cover these next time in what the rules are. We're going to take one more session on this. And then we're going to move on trading logs. So maybe we're just going to need 2 more Sundays, and then we should be done with this here. All right, so that's going to be all from my side for today. Do you guys have any questions? All right, doesn't look like it. All clear. Good session. Super clear. All right, guys, thanks a lot for joining and staying until the end. I'll catch you all next week. Until then, have a great start into the new week. Happy and safe trading, and ciao.